Setting up a quality portfolio to grow your wealth is easier than ever before. It can be done in a matter of minutes at any online broker. Don't get me wrong, there are a lot of intricacies to learn in investing, but self-managed low-cost ETFs or exchange-traded funds make it easier than ever to put your wealth accumulation on autopilot. In this video, I'll help you build the right portfolio for you based on your age and situation. The level of risk tolerance and investing goals will vary from person to person, but my goal is to give you an idea of what's out there and leave the rest up to you. I really do care about your financial future, but nobody cares as much as you do. Let's get you the tools to get started. If you're new to the channel, welcome. My name's Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you enjoy videos like this, please obliterate that like button with unreasonable force and tell a friend about the channel. It helps a lot and I really appreciate you. ETF Categories. An ETF is simply a basket of stocks. When you buy a single share of an ETF for say $100, you get a little slice of usually over 100 companies with that one share. And the best thing about the ETFs mentioned in this video is that they are all passively managed and based on a specific index. This means a few things. First, all these ETFs have a very low expense ratio, keeping the profits in your pockets. Second, they avoid gut decisions by a human being. This keeps emotions out of your portfolio. Third, they auto-update based on an underlying index. This means that dollar cost averaging into them always works long-term. And what I mean by that is sometimes when you dollar cost average and you lower your cost basis as a stock, as an individual company is falling, you're really just trying to catch a falling knife. Whereas with index dollar cost averaging, as the index is falling, that means the overall market that it's based on is falling. So you're always buying the dip that will eventually go back up. You're not YOLOing your dollars into an individual stock just because it's at a discount, where that specific company could go poof and you lose everything. So if you plan to buy and hold these ETFs forever, or at least for a long time, you're always properly buying the dip. I use the same 3 ETF categories for building a portfolio for anyone at any age. And these types of ETFs are the cornerstone ETFs, which track the US stock market. Growth ETFs consist primarily of growth stocks, and dividend ETFs consisting of dividend-paying stocks. A quick note, many growth ETFs consist of dividend-paying companies. Take Microsoft, for example. Most people would consider Microsoft a growth stock over the years, but Microsoft has also paid and increased its dividend for each of the last 19 years. Stocks, and thus ETFs, will usually touch multiple categories, but it's usually clear what the primary focus of each one is. Let's get building. Age 0 to 29. Investments made for your children, or those made by young adults beginning their career, should focus primarily on growth. My default recommendation for the people that are 0 to 29 years old would be about a 40% cornerstone, 50% growth, 10% dividends split. And again, your specific allocation will depend on your investing goals and your risk tolerance. I'm throwing out some default allocations that I think would work for the masses if you average out a bunch of people's preferences. Like, for example, in this category, I didn't roll with any dividend stocks or ETFs, but I don't necessarily think it's a bad idea to have a little touch of them. With that said, I wouldn't go too crazy on dividends at this stage, because even with a major recession, you're only massively accruing wealth if you're a buyer, a consistent buyer that DCAs into your portfolio's allocations. Let's quickly check out the specific ETFs that we'll be using for this portfolio and the other portfolios later on. Here are the 4 best dividend ETFs that I found via the ETF screener at Seeking Alpha, which I consider the best website for stock and ETF analysis. So I came up with SCHD, VIG, VYM, and DGRO as the dividend ETFs. So these would all go in the dividend category. I pulled what I consider the 3 most important metrics for dividend ETFs. I pulled the yield, the 5-year dividend CAGR, this is the dividend growth rate, and the 10-year total return for each of the ETFs. As you can see here, SCHD has the highest dividend yield, so it pays you the most now of these four. It has the highest 5-year dividend growth rate, so it grows more in the future. And it also has the highest 10-year total return, albeit it's barely ahead of VIG, which is more of a growth-based dividend ETF, but it still has it by just a hair. And this is as of market close, November 20th. That is when I pulled all the metrics I'll share in this video. My dividend ETF will always be SCHD, but feel free to pick your own from this list or any other ones that you may like. For the growth ETFs, I use the tickers VGT, QQQM, but as you can see here, the data comes from QQQ, which is also a NASDAQ 100 ETF with a slightly higher expense ratio. So QQQM was too new, but the metrics are basically the same as QQQ. Besides a 0.05% difference in their expense ratios, they're identical. And then IWY and SCHG. So much like the dividend ETFs, I took the 3 primary metrics. Now for growth ETFs, we're definitely concerned with 10-year total return, but I figure since I already had the data, I might as well plop it in here because the yield and the dividend growth rate can help a little bit. So starting with the least important ones, VGT ranked first in dividend yield with 0.7. It ranked first in 5-year dividend growth rate at 13%. QQQM was also very solid on that. And VGT ranked first by a mile in 10-year total return. And QQQ is actually second by a mile. As we talk about growth ETFs, I personally go with VGT, but it is 100% tech. From a sector perspective, QQQM follows a very well-established index of the NASDAQ 100, which I always mention has obliterated the S&P 500 in its 38-year history. So I wouldn't fault anyone for going VGT or QQQM or a combination of the two for their growth ETFs. And for the cornerstone ETFs, I have good old VOO, which is the S&P 500 tracking ETF from Vanguard, and VTI, which is the total US market tracking ETF from Vanguard. So they usually have very similar return histories, and a lot of that is because they have an 86% weighted overlap. So of VOO's holdings, which is the S&P 500, those 500 companies make up 86% of VTI's holdings, which has nearly 3,800 companies. So the little small guys and the mid-sized guys only make up 14%. Otherwise, these are 86% the same. You can see that their yields are basically the same. VOO slightly higher. Their 5-year dividend CAGR, VOO is slightly higher on that. And then their 10-year total return, VOO is actually quite a bit higher. Normally, this is closer. If you stretch it out over 25 years, VOO is barely ahead. And there are plenty of years VTI is better when the little guys, the small and mid-sized companies are getting more love. But this will even out over time. I think personally, VOO is always a little better, and I carry VOO as my cornerstone, but VTI is just as good. Pick one and go with it, or buy half of both. These are the results for 0 to 29. So again, I chose VOO, VGT, and SCHD. Those are interchangeable with the other ones, but using those ones and running the metrics through at the 0 to 29-year-old allocations that we discussed, we'll have a weighted yield of 1.32% on the dividend, a really nice 5-year dividend growth rate of 10.4%, and an extremely juicy 348% return over the last 10 years. Again, the next 10 years could be completely different, but we had to put together some data to just show the differences between allocating more growth versus more dividend. Age 30 to 39. It's nice to get a little dividend snowball going once you get into your 30s. But remember, at this point, you still have a lot of years to recover when your growth ETFs go to the moon and then come crashing down in a recession, and then recover and then correct and then go up and down. You have lots of years still. I would peg a nice default at 40% cornerstone, 40% growth, and 20% dividends at this point. Now again, your retirement goals won't be strictly based on age. So if your goal is to retire when you're 40 or 35, you're going to have to think outside the box a little. These typical ages are just for the masses, but you may want to have 50%, 65% dividend ETFs at this point based on your situation if you're going to be living on your portfolio earlier than most people. I just wanted to throw that out there that I'm going to keep this broad in general, but there's always exceptions. Let's take a look at the results for the last 10 years of this portfolio. Here we are on the 30 to 39-year-old table. So there's those allocations of 40% to growth and cornerstone and 20% to dividends. And when you use that mix, you get a little higher dividend yield of 1.62%, a similar 5-year dividend CAGR of 10.5%, and a little lower but still extraordinarily juicy 315% total return over the last 10 years. Age 40 to 49. Welcome to my age bracket, everyone. Here is where I think there's the most differing opinions and fluctuations on what the right portfolio is. Some people in their 40s are looking to retire very soon, while others are still extremely early in their careers. And I'll say this is the first age bracket where I wouldn't think you were crazy if you had up to 50% allocation of any of the 3 categories: cornerstone, dividend, or growth. With all that said, my recommendation here, and I do practice what I preach by the way, is about 1/3 of each category. Now, my 1/3 of each category is slightly leaning towards my growth ETF, and I use VGT for my growth ETF, and then VU and SCHD, like all the other ones, for my cornerstone and my dividends. And this portfolio, I can tell you from experience, at least most of this run, has outperformed the S&P 500 for each of the last 10 years. And that's a rare feat. Here's what it looks like. If we decide to go 1/3 of each, the results here show almost a 2% dividend yield. So that's creeping up compared to our younger years. A nice 11% flat dividend growth rate, and a slightly lower but still incredible 290% total return over the last 10 years. Age 50 to 59. When you hit your 50s, it's time to push the pedal down on those dividends. But you're still very young at this point. So don't go too crazy on the dividends if you have a stable and well-paying job. My default recommendation for people here is 25% cornerstone, 25% growth, and 50% dividends. Let's see what this looks like. All right, now here at 50 to 59, we're starting to see the dividend go up quite a bit with that 50% allocation that we discussed. We're up to 2.4% dividend yield, a very healthy 11.7% 5-year dividend growth rate, and still a very lucrative 259% total return over the last 10 years. Age 60 to 69. Now it's time to open the dividend floodgates. If you're planning to live on dividends and you don't have the portfolio value to support that quite yet, this is where you can consider going 100% dividends if you want to retire. And if you still don't quite have the portfolio value to spit out the income with SCHD, along with your pension income or your Social Security income or any other income flows to comfortably retire, you may consider putting a portion of your portfolio into JEPQ, ticker symbol JEPQ. JEPQ has a very juicy 10.8% dividend yield, as it uses some covered calls to bolster that. But it also has great underlying holdings, in my opinion, with the NASDAQ 100. The NASDAQ 100 has crushed the S&P 500 for its 38-year history. My default recommendation for this group is 15% cornerstone, 10% growth, and 75% dividends. Let's check it out. All right, with this 80% dividend ETF allocation, that puts us up at nearly 3.2% yield. So if you have $1 million portfolio, that'd be $32,000 per year to add to any other sources of income like Social Security. Almost a 13% 5-year dividend growth rate. That will have you destroying inflation in your retirement. And still a very respectable 204% total return over the last 10 years. Age 70 plus. Here's where most kids would say, of course you go all in 100% on dividends at this point. Now, while that isn't a bad idea in a vacuum, remember, 70 is still pretty young in today's society. People these days are living longer than we ever have before, so you still have 20, 30 years, 40 years of quality investing decisions to benefit yourself and your future generations. My default recommendation is 10% cornerstone, 10% growth, and 80% dividends here. But remember, when you're 70 plus, you may have way more portfolio than you ever need, and you could go 50% growth at this point while not affecting what you need. Or you may never have the portfolio that's quite necessary and you're 100% dividends, including some of them being in JEP-Q. This is such a wild variation at this point because people have a lot different amounts. They have a lot different needs in retirement. So this is the toughest one to put a default peg on. I did it, but it can vary wildly depending on your situation, and you'll have a good idea of what you need to do at this point. Let's view a quick summary of this group and all the other groups put together here now at the end of the video. All right, now we're selling out and we're going almost all in on dividends at 90%. And that gets our yield up there to just sniffing 3.5%. You have a 5-year dividend growth rate of 13.3%. That's just insane. And a 10-year total return of 185%. I would not complain about that at all. So here's a summary of all the results. We're starting here in column B with age. So we have the 0 to 29 all the way through the 70 plus. If you look at the yield, this makes sense as when you're younger, you're in your wealth accumulation stage. You're not kicking back those dividends, you're reinvesting them anyway. So you might as well focus on this elite total return over here. And if you're getting older and you're 70 plus, you're probably living on those dividends. Same with a lot of the people in the 60 to 69 and the 50 to 59. So these yields are a little higher. That's what those allocations do for us. The total return goes down, but we're not too concerned about the value of our portfolio as much as we are with the cash flow that we're living on. The last 10 years have been really good. All these numbers might be juiced compared to what the next 10 years do. You never know what's going to happen in the future based on past results. But the point of this video is just to help allocate for the things that matter in each age group or stage of life or stage of your career, depending if you're retiring early or working into your 60s. But the bottom line is you'll want to increase your yield as you get closer to needing to draw on those dividends. I cannot believe that you are still here at this point. While there is certainly something wrong with you, you are one of the real ones, and I do appreciate you. Check out one of these 2 videos if you still would like to see more. And I'm also going to put all the videos with detailed information about the ETFs that I talked about in this video in the description below. So if you want to take a deeper dive, I'll go over a lot more in these videos. Thanks again for watching, and I will see you next Thursday, and sometimes on a Sunday. Peace.